what you're going to see is you're going to see two lines. You're going to see a 25 period moving average, which is kind of a more of a lagging one. So it's kind of drifting off price a little bit. They're both pretty close, but they're drifting off price a little bit. And you're going to see a, what did I say, 15 or 10, whatever I put on there. That's going to be a pink one, which is more reactive to price. So as price ebbs and flows, that moving average is ebbing and flowing with it. Now, you can also use a double moving average as a directional filter, meaning that you only look for buying opportunities when the faster moving average is above the slower moving average and vice versa. But specifically for an entry technique, what you can use is something called a moving average cross, and that's when one moving average crosses above the other. So if I go back in time, and hopefully I can find an example here. If I go back in time to a period where price action changes, meaning it goes from one extreme to the other. Here's a perfect one right here. So again, for the audio only audience, I'm going to try my best to explain that. So I'm looking at a chart right now, and price action had come out of a bullish move, and we started to do a bearish pullback, right? So price went up, and then we started to retrace back down. Now, as price retraced down, at some point, my smaller EMA, which is a 10 period, right? During the move up, it was trading above the bigger moving average to 25, and then during that pullback, it actually crossed below. Now, what happened is after price pulled back, it found a little bit of a bottom and it started to extend higher. There came a point in time where that smaller moving average, the 10 period, recrossed above the slower one. So if you are someone that is looking for an entry indicator with this, right, this would be your opportunity to buy. So an example would be like a pullback trader. A pullback trader is someone that wants to buy on the pullback. So price is trending in a bullish direction. It gives us a little bit of relief, a pullback, an outside return or retracement. And they want to ask themselves, how can I get involved on this pullback or in this pullback and trade for the higher extension? So there's many different ways to do it, but one, using a moving average as an entry indicator would be to wait for that smaller moving average to cross back above the longer moving average, and then that is where you enter. You enter what's called next bar market. So as soon as that thing crosses and closes, right, then you enter the next bar market, and now you're involved in that move. This can also be combined with the bigger directional filter as well, if I don't get too complicated. Whenever I get on the charts, I get really nerdy, guys. I'm sorry for that. Let's bring back on our 200 period moving average, and let's see if we can put these three together.